Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and I have Jesse Vandermeer and Andrew Chang with me. And we're looking forward to the next installment of our webcast. So let me just get right into it. As you know, below you, if you've been on webcast before, you know that we have our presentation there, and you can click on that. We'll also go back and forth between the presentations and ourselves. And this is a great time to update our clients. In particular, today is actually a nice volatile day in the marketplace. So hopefully it'll open up more opportunities for us to make some great purchases. On the first slide in our presentation, there's a disclaimer slide, and we always want to emphasize that for legal reasons, regulatory reasons. So apprise yourself of that slide. And then on the next slide, we actually have the outline of the presentation today. And again, just a quick view of our investment philosophy, investment challenges, key issues that we're seeing in the marketplace to date in 2020, and also these challenges that we believe will extend really for the next couple of years as we adjust to the last number of months. Our strategy, our positioning, a quick update on our performance, and then Jesse's going to take you through one of our companies, Algonquin Power, and Andrew is going to give you a quick overview of Amazon, another one of the holdings that we've had in our portfolios for some time. So let's get right into it. I'm going to share the screen now with the presentation, and then away we go into the presentation here. There we go. So I apologize there. Okay, so we've got that, and I apologize. Now we can get right into the presentation. There's the disclaimer. There's our overview, which I mentioned. Just a quick update. In terms of our company, we're about 165 million, 140 households. And in terms of our investing, as I emphasize every presentation, I really think this is important for our investors. Be independent thinking, deep understanding of investments, focus on the current realities, understanding past, and then using an interdisciplinary approach in terms of a worldview. In terms of our investment philosophy, as our clients know, we buy companies that are what we believe are excellent companies. So they have really good economics, and we've listed a couple of those economics there that matter: free cash flow, strong balance sheets. We also run focused portfolios, so 20 to 30 stocks, and that's also important to emphasize for all of our clients. We're not all over the place. We zero in on what we believe are the best opportunities. We also like to hold companies for extended periods. That allows tax-deferred compounding. And we also purchase with a margin of safety. So we're very parsimonious. We want to be economic in terms of our purchasing. And then understanding the current economic backdrop. That is really important in the day in which we're investing now. Now, investment challenges, we've talked about these things over the years, and certainly the number one challenge we believe is excessive global debt. That's just the fact that there's debt everywhere on government level, personal level, corporate level. Also government promises, unfunded government promises. Those would be all those pensions and healthcare, all the things the government says there's lots of money for, but have not really set aside money to pay for these things. And this is an ongoing problem, particularly given the demographics, which I mentioned there. And that's led to monetary policies, or policies on the behalf of the central bank, of printing lots of money. I'll talk a little bit more about that today. We've entitled the presentation "Printing to the Finale," which basically means they're just going to continue printing money and keeping interest rates as low as they can for as long as the eye can see, or until there's something that they lose control of. So lots of printing money, and interest rates have been at record low levels. And then fifth, I've just added here this lockdown folly. I've talked about this on other presentations, but right from the beginning, there's no way anyone could really understand what our authorities were doing in terms of locking down an economy and then saying you can make this up by the government taking from the private sector anyway and just giving back to us. In other words, the public sector doesn't create wealth. It has to take it from the private sector. And so all this money that the government's handing out, trying to make up for the lost value of businesses and incomes and payrolls and so forth, they're just stealing it from us in the first place. And so this is really going to have a long-term negative impact. And so I've just put here that this is really the most devastating and costly self-induced decision. In other words, it wasn't like going to war and sometimes you're forced into circumstances. This is a global mistake. It's a huge mistake. And estimates put the cost of this lockdown at somewhere around $30 trillion in terms of total global losses and capital formation destruction. And we will not make that up anytime soon. That's a huge cost. And we believe that this is going to be a lag in terms of our economy. We're going to see the impact of this for some time. It's not going to go away quickly. I just put this up here because when I talk to people, I'm shocked at how little they know about the mortality situation with the coronavirus. And I've entitled this Lockdown Folly. So you can see on this slide, this is just as of June 8th. So 2 days ago, 3 days ago, it runs through the population of Canada. This is looking strictly at the Canadian statistics. We've got about 38 million people. If you go down halfway, you'll see that the number of deaths is around 7,900 people. And of course, we don't want to see anyone dying before their time. But the reality is, of course, none of us live forever, and there is a constant mortality rate in the population based upon all sorts of things. But it's important to look at actually who is dying in regards to this coronavirus. Really, if you look at people 60 plus, that's 97% of the individuals who have passed away. And in terms of LTC, which is long-term care, over 83% of the deaths have taken place in long-term care facilities. Those under 20, no one has died in Canada under 20 as a result of this coronavirus. The reason I put this up is that if you look at flu, if you look at suicides, you look at all sorts of other causes of death, drugs, overdoses, and so on, the statistics in many cases are actually a lot higher than this. And so what we've done is we've actually locked ourselves down. We've taken people out of work. We've shut down our economy for something that really has a mortality rate when you're below 60 that's less than the typical flu. And so that's why I say that this is a really, really major mistake in terms of policy, and a very costly one. And it's very important that our leaders would open up our country as quickly as possible. We make certain changes to our cleanliness practices and protect the true people who are vulnerable, which is the older people and people with hugely compromised immune systems. And so key issues in terms of the market going forward, we've emphasized this to our clients. Market valuations are high, and so we are very careful. We don't want to just put all our money into the market right away. Just because the market's going up, as I say in another slide, we're not going to chase it. We want to be very careful. We've also seen the failure of monetary normalization. What do I mean by that? It's a big term. Some of our clients are not as familiar with economics, but what it means is that all of the central banks over the last couple of years, prior to 2020, we're trying to get back to normal interest rates, trying to get back to conditions where you don't have to print money. It's failed. We could not increase interest rates in the United States for any sustained period. And so that's what I mean by monetary normalization. We actually cannot get back to a normal situation where the interest rate is, a couple points above inflation and you can make a real rate of return. And so this is serious. It tells us, again, to be careful when it comes to investing. We've also seen an unprecedented increase in debt levels because of the lockdowns. So already we had a debt problem, but in Canada, and I'm just giving you a quick estimate, between the federal government at $250 billion extra in debt, and put that in context, in Canada, our federal debt prior to these lockdowns was about $750 billion. We're going to add $250 billion to our government federal debt, which will put us about $1 trillion. I mean, that's a 33% increase in our debt in just a matter of months. Across the provinces, we're certainly going to add another up to 100, potentially up to $100 billion across the provinces. And so this is serious. And you can just multiply this across Europe. You can multiply it in the United States. You see the number in the States. We'll talk a little bit about the US as an example in a few moments. This is brutally expensive. And the politicians are not talking about this. And we as investors, we should be very concerned. Our leaders are not leading us in the right direction at all. The debt-bearing capacity of the governments has been maxed out. And so what that means is, you take Ontario, for example. Ontario cannot issue that much more new net debt. In other words, keep adding to its debt pile. We're already seeing credit downgrades in Ontario. we're going to top about $400 billion in debt pretty soon. And so what's happening is the Central Bank of Canada is actually buying our debt. So it's just monetizing, it's printing money to buy Ontario province debt. Again, that's not a sustainable situation. And we're seeing this across many different countries. Central banks are addicted to money printing. And we also have historical amnesia. We really, if you listen to economic professors, you listen to our so-called intellectual elite that run our country, they somehow think that we can get away with this. And they have this historical, I call it historical amnesia, that this story does not end well. You can't get away with this. So I put up a little quote here from Samuel Taylor Coleridge, who is a well-known poet, writer. He says, "If men could learn from history what lessons it might teach us, but passion and party blind our eyes, and the light which experience gives us is a lantern on the stern, which shines only on the waves behind us." We are not looking forward at all. And this is a big problem. So if you look at money printing, I'll just give you a couple of quick slides here. I always like to go back. You look at the Roman Empire, and it was classic for devaluing its money when they were overextended and couldn't afford to, pay its military, and the social welfare system was out of control, and people were living off the state, and so on. You can see that back around 64 to 68 AD, you had 90 to 100% purity in terms of your coinage. Back then, they didn't have digital money, paper money. They would have coinage, and it would depend on your silver or gold content. And so you had 90 to 100%. But as the country got increasingly decadent and lived beyond its means, and you can, there's a whole host of things you could talk about in terms of Roman civilization going down the tube. They eventually just kept lowering the silver content. So in other words, they're watering down their money. They're printing coins, but there's no value to the coins. There's no collateral in the coins anymore. It's just, they were garbage. They're just different alloys that they were mixing with the silver. And by the time you got close to the end of the empire, they're basically putting out coins with virtually no silver content. That's what we're doing as a country, and as nations around the world. And so in the next slide, you've seen this before. I've had this in presentations. If you go back to 1969, the price of gold was $35 approximately. It was fixed at the time. And today gold's about $1,750. And you can see that the value of currencies have dropped. And this is a logarithmic chart, so you can see that it goes from 100 to 10. So that's a 90% drop. You can see that all the major currencies in the world are down 90% plus against gold. And in some cases, like the British pound, or you look at the US dollar, they're down 95, 96, 97% against gold. And what that's telling you is that, again, we're watering down our money, and we're continuing to increase the money supply. And this is a major issue when it comes to where we invest, how we protect you. Just a couple of quick slides that I took from Double Line's presentation recently, just a couple of days ago, that are very instructive. You can look at this chart, and it's basically looking at the different episodes in the United States. So this is looking at the United States, the central bank of the United States, and it has QE1, QE2, that's QE3, QE4. These are the different episodes or time frames where the central bank added to the money supply or printed new money. And you can see back at QE1, that was back in 08 to 010, they added about 200 billion. Then you see QE2 back in 2010, 2011, they added about 565 billion to stimulate the system, and they started printing. And then I'll jump to QE3 there. They added about 1.6 trillion over the course of really almost about a year and a half or so. And then we look at just the first couple of months. I mean, you're really talking here about 2 months. In 2020, they've already added about $2.8 trillion, and that's just going to continue growing. They just told us yesterday it's going to go up a lot more. The point of showing this slide is you can see here, once you get addicted to money printing, you have to print more and more and more and more. You don't just settle out at some level. You have to print more and more to keep the system stimulated. And so this is a growing problem, and it's not going to go away anytime soon. If you look at what's happening, and this would be the same thing in Canada, you sort of divide by 10 probably, and you're going to get pretty similar numbers. But if you look at what's happening over the last little while, in 2019, you can see that there was economic growth, so GDP growth, but the debt was still growing faster than the GDP growth. That's not a healthy situation. This is looking at the United States. So you had the GDP goes up by 800 billion, but your debt goes up by 1.2 trillion. That's not long-term strategy that's going to work. It's disastrous. But interestingly enough, if you look at the first half of 2020, if we're go forward a couple months from where we are now, if you look at the end of this month, we're actually going to see a reduction in GDP of about 2 trillion. And we're going to see an increase in debt in the US of 3.5 trillion. So when you shut down your economy and then you just spend money like drunken sailors to try to make up for the total lack of production and wealth creation in the private sector, you're not only shrinking your GDP, you're massively increasing your debt. And so what's happening is you're getting this huge spread that's taking place that's adding debt to GDP at an unprecedented rate. And you see the same on the right-hand side of this slide. Also, if you're looking at it in terms of percentages, 9.4% shrink in GDP and then a 15% increase in debt. This is staggering. This is going to have impact on our economy. And don't fool yourself. It can't be papered over by printing money. And so we need to be careful. And then if you look at this slide, without getting into too many details, you can see that this is the balance sheet, or how much money is printed as a percentage of the total value of goods and services produced in the economy. So you take all the money that the central bank prints as a percentage of GDP. And there's no reason why in a healthy economy, the money that is on the balance sheet really should be more than 10 to 15% of the GDP. If you've got good velocity, good healthy economy, production, and so on. But you can see what's been happening. If you take the BOJ, which is the Bank of Japan, which is, Japan's been a disaster now for really 30 years. You can see that they just continue to print money until the value of money printed in that country has now exceeded their GDP, which is really quite outrageous. You can see that the ECB, which is the European Central Bank, and the Federal Reserve in the US, they're now up to 46% and 32% respectively. And what I don't like hearing is when people say, well, the Fed is only at 32%. If Japan's at 100, hey, we can go to 100 too. We can just keep printing money. And you hear that more and more by politicians who are completely uninformed about economic reality. And so if we have more and more of our countries and more of the central banks just continuing to print more money, we're going to have to be really careful about purchasing power. It's going to put us in a very dangerous position. And I fear that that's exactly what they're going to try to continue doing in order to, even just to keep the game going rather than to solve any problems. And then I've just got a couple slides here before I just look at our performance and where we're investing. The 2-year Treasury, the whole point of this is just to say that we're at record lows. It actually hit 14 basis points. So you buy a 2-year bond backed by the US government, you're getting 14 basis points per year, so 0.14%. Again, record low. Same thing on the 10-year. The 10-year went down to less than 0.5% per year for 10 years. And that's in the US where there's still positive interest rates. These are all record lows. And then you look at the 30-year, the same thing. It actually got down to a low of 1%. So who in their right mind is buying a 30-year bond for 1% return when you know that they're depreciating and trashing your currency and devaluing it all the way through? So this is a problem. And I put these up just to show that these interest rates are way too low. They're not healthy. They cannot normalize, which tells you that we're in an economy that's under stress. So what do we do as an organization, as a company? We've talked about this before. We minimize financial institutions or companies that have lots of leverage. The banks, for example, are going to have a tough time. We've had major mortgage deferrals go on in this country at twice the rate of the US. Our banks are going to have a tough time going forward. In other words, in their best case, they're not going to have earnings increase for some time. And so we have very little exposure. Minimize exposure to economically sensitive commodities that require a rip-roaring economy. Yes, we're going to get a bounce back, but we're still going to be below where we were in 2019. It's going to take some time to even get back to our 2019 level. And do that in a healthy way, particularly with the government expanding so much of its influence in the economy. Minimize exposure to consumer discretionary businesses, require a lot of extra money for people to buy things. Maintain a healthy exposure in precious metals. We've talked about that before. This is a tremendous hedge to the problems in the world. Maintain significant positions outside of Canada to access higher growth opportunities. Maintain equity weightings in core businesses with strong balance sheets that are essential to the economy. Maintain liquidity. We've talked to clients about this. We're keeping higher levels of cash. We want to keep higher levels of cash. Just because the market's gone up a lot off its bottom in March does not mean we cannot test those bottoms. Don't fool yourself. We've got a lot of challenges ahead of us. And if the market hasn't accurately priced those in, we can quickly see a reduction in the market. And that is not going to surprise us in the least. We will be patient and not chase stocks. In terms of just the last slides before I hand it over to our guys to fill you in a couple of companies, we have been fortunate. Our performance has been stellar. We can't promise that it's going to continue the way it's gone on the last number of years, but we continue to work hard. This is looking at our total business, our total ROCKLINC, client portfolios. And that's about 70% equity, 30% non-equity. And so really over the last year, we're up about 17.5%. This is as of the end of May and after all fees. So year over year, 17.5%. And we've been averaging about 9% over the last 5 years per year. That's an annual compound rate of return. And if you compare our pure equity holdings, no one has a pure equity holding portfolio. Some people have 90, 95% in equities, others 50%. But if you just look at our equity performance and compare that to the TSX, the Toronto market, and the S&P 500, and these are the total return indexes, so with dividends all reinvested. Over the last 5 years, we've been pumping away at about 14% a year, and the TSX at about 2.2, and the S&P at 9.9. And over the last year, we've been very fortunate. We're up about 26.2, which is absolutely trounced the indexes. So again, we're just giving you highlights of what we've done. And I can tell you right now, this is not what we're going to do in the future. It won't be exactly this. We'll shoot for this or even better, but it's going to be tough slugging, I think, in the marketplace. So that gives you a quick update. So we want to be careful, and I'm going to stop sharing that screen and come back. We want to be as careful as possible in the market. We're not trying to be negative, but we want to be realistic. What we've imposed on ourselves globally with this lockdown and this massive increase in debt and trying to get back to some normal condition will take some time. And the markets, in our view, we want to be very careful how we price this in terms of the businesses. So we want to talk about two of our holdings. And so I'm going to hand the floor over to Jesse Vandermeer, who will talk about Algonquin Power. Jesse?
Thank you, Jonathan. As Jonathan mentioned, I'll talk about Algonquin, which is a recent addition to client portfolios and the ROCKLINC Partners Fund. This company is unique in two ways. It has both a renewable power generation business and a utility business. Typically, these businesses would be under separate companies, but Algonquin is rather unique and has both substantial presence in both sides of these businesses. Secondly, it's unique because it's a Canadian headquartered company, but the vast majority of its assets, over 80%, are in the United States. This is not typically the case. The fact that it's Canadian headquartered is great. We were actually able to visit management earlier this year. They're just located in Oakville. We went over, asked them questions, got to learn more about the company, go up the learning curve, derive some information that you can't just derive from looking at an annual report or financial statements. So that was great. And at all our businesses, we try and contact management. It's a great way to learn. So Algonquin is unique in those two ways. I'll share the screen now. There's some graphics from Algonquin's investor relations material, and it really helps explain both its business segments. It actually has a third segment, which is amalgamated with the renewable segment. It's called Global Infrastructure, which is just a large equity investment in a developer of renewable assets and some transmission assets. So I'll move on to the first major segment, which is its utilities assets. Algonquin owns and operates a diversified portfolio of 40 regulated electric, natural gas, and water distribution systems. So it has $6 billion in these utility assets, and it's spread across 13 states and 1 province. There's about 768,000 utility connections. You can see the breakdown there between those 3 major types. A reason that we're attracted to Algonquin is that it has a proven track record of acquiring utility systems and assets. The market is quite fragmented. There's very large players, but there's a lot of small utility systems across the states. And Algonquin is a fantastic consolidator of these assets. It's able to buy them for fair value and improve its operations and grow its asset base. It aims to acquire utility systems that are near existing owned utilities. And so it knows the market, it knows the regulatory authority in that state, and it's able to drive value that way. Additionally, because the market is quite fragmented, this offers a great runway for growth. Algonquin anticipates a $7.5 billion 5-year investment program. This consists of both inorganic and organic opportunities. And we look forward to see how it can continue its strong track record of acquiring various utility systems. Secondly, its non-regulated renewables segment. This is majority denominated by wind renewables. Around 3/4 of its renewable segment is wind power. It's an able operator and developer of these projects. You can see in the map below from Algonquin the various locations of these projects. We're quite fortunate here in Canada to have a large presence of able global developers and operators of renewable energy. Canada was relatively early vis-a-vis many other places in the world in terms of global development of renewable energy. So we have a number of Canadian names that are really high quality. And some of these that you own in your portfolio already, which may be Brookfield Renewable, there's Algonquin, there's Northland Power, and TransAlta Renewables. So we're quite fortunate to have these fantastic players right here on the Toronto market. I'm not going to touch on the third segment in detail because it's quite amalgamated with the renewable segment. It's an equity stake in a large yield co in Europe, a renewable operator and developer of renewable assets and some transmission assets, including water. So these two major segments, it's quite unique to have them under one corporate umbrella, and also quite unique to have such a large American exposure in a Canadian headquartered company. And we like the US market in general, and it's a great opportunity for consolidation for Algonquin. So it's a really straightforward business, and the best businesses are simple to understand. It owns utilities and it owns renewable assets. This generally is characterized by contracted cash flows. These cash flows have contractual arrangements for inflation escalators. And also, in general, as we see in our environment today, and as Jonathan mentioned earlier, we're faced with low interest rates for some time. The FOMC meeting from the Federal Reserve, we're expecting low interest rates, no interest rate increases until at least 2022. And we'll see beyond that point if they'll raise aggressively from there, which likely they won't. Also, they have these long contracted arrangements allows high visibility to revenues, and less than 5% of the business is exposed to merchant pricing. Secondly, there's a large exposure to the US. When compared to Canada, they have a lower penetration of renewables. So this offers a great opportunity for the development of many projects across the country. They're an excellent acquirer of utility systems. They have a long track record of successfully integrating and improving the operations of acquired utilities to drive value. And they're an experienced developer. A large amount of value also comes from development. They have a 5-year growth plan of $7.5 billion, which I believe recently was actually upgraded to $9.2 billion. So there's plenty of opportunity for them. Additionally, with their equity investment in Atlantica Yield, there's potential for expansion globally. We have a number of Canadian companies that have done so, renewable companies that have done so, like Northland, like Brookfield. And Algonquin has potential to go beyond its North American presence and go global, which is great. So for these 4 key reasons, we like Algonquin. We like the management. It's great to meet with them. This is a stable business given the challenges that we face, both fiscally, monetarily, and with the consumer as a whole. This is a great business with its contracted cash flows, with a well-deserved place in portfolios, a great income-producing security business, and will likely to be a staple for some time to come. I'll now pass it over to Andrew, and he will talk about Amazon.
That's great. Thank you so much, Jesse. Many of you may already be quite familiar with Amazon, whether it's buying a gift during the holiday season, comparing prices of a prospective purchase, or maybe most recently, buying household items during the lockdown. Over the years, Amazon has become a behemoth and operates a significant number of businesses. For the scope of my presentation, I am just going to focus on 2 of its main businesses, the Amazon Marketplace ecosystem and Amazon Web Services. I'm now going to just share my screen just so you can see the first slide. So the Amazon Marketplace ecosystem. No company has disrupted the retail industry quite like Amazon. Feared by many competitors, Amazon has become an e-commerce behemoth. It boasts the largest e-commerce platform in North America by gross merchandise value, which is the total value of goods sold over a period of time. Last year, Amazon had a gross merchandise value of $335 billion. From initially selling books online, Amazon now captures over 35% of all US retail e-commerce sales. Now, underlying the explosive success of the Amazon Marketplace ecosystem is Amazon's powerful business model, which is built on Amazon's virtuous cycle of growth. Now, the virtuous cycle first starts with customer experience. High-quality customer experience drives traffic to its website. High traffic buyers will attract more sellers. This results in more product selection and in turn drives more customers to the website. This in turn drives more sellers and product selection and creates the cycle of growth. As the company becomes larger, it is able to lower its cost structure by leveraging its website and logistics infrastructure to drive down incremental cost per unit of items sold. Amazon can then take these profits and reinvest back into the business to build a better customer experience. Cost savings are then passed on to customers in the form of lower prices, and in turn, driving further traffic to its website and driving further growth. It's like a snowball running down a hill. It becomes larger and larger and larger. And these types of business models, like many of the technology companies like Google and Apple, is what really drives and makes these companies so large and successful. And this gives Amazon an economic moat. It makes it very difficult for its competitors to compete against. Now, this simple but powerful model has been proven to be quite successful. For example, according to Statista, Amazon was the 5th most popular web property in the United States. Amazon has also amassed a large following. There are over 150 million Amazon Prime members who pay a yearly subscription to enjoy free 2-day, 1-day, and even same-day shipping of over millions of items, and also enjoy Amazon's video and music streaming service. Amazon has also attracted a large seller base of over 2.5 million third-party sellers. Amazon has reinvested its profits back into the business and has produced a massive infrastructure and logistics network. For example, last year, Amazon delivered over 3 billion packages alone on its own delivery network. Now, in comparison, UPS delivered 5.5 billion global packages and documents. Now, Amazon has not only disrupted the retail industry, but also the enterprise IT market through its cloud computing business, Amazon Web Services. Amazon is a pioneer of cloud computing, which is used in many applications, from streaming movies on Netflix to hosting many of the apps that you use on your phone. Previously, companies would need to buy and maintain their own physical data centers and systems and manage their own IT infrastructure. This would require a significant amount of resources, making it quite costly. Through Amazon Web Services cloud computing, companies no longer need to have their own IT infrastructure physically on-premise. Instead, customers can, in essence, rent the same IT computing resources from Amazon and access their servers, their networks, and operating systems and storage through the internet. Customers would just pay Amazon Web Services on a pay-as-you-go subscription basis. And this is very beneficial for companies, as there's no upfront cost to build their own data systems. Customers pay based on usage, which means that they won't overpay or overcreate too much storage. And it's also scalable, which means customers can dial up their cloud computing needs as their business grows bigger. And Amazon has built a comprehensive breadth of solutions in machine learning and artificial intelligence that helps customers advance their capabilities in automation, quantum computing, Internet of Things, and data analytics. Now, why do we like Amazon? Now, there's, as I'm walking through just the business, you can just sense and see just the power of its business model. Amazon is a dominant leader in both the consumer retail and cloud market, which are two important areas of growth that we see. Consumers account for about 70% of the US GDP and is a significant driver of the economy. Cloud computing is also in the early innings, has a large runway of growth. Many companies are increasingly needing the use of data, and we believe and will need more cloud computing resources. And we believe that this industry will have a large runway of growth. Amazon also has a marketplace as a one-stop shop platform. They've created a diversified category of low-priced products and fast delivery, which enables the company to capture great customer loyalty and market share. One of the unique things about Amazon is that it's amassed a rich collection of consumer buying behavior data, which it's able to use for its advantage to optimize its search algorithms to make recommending products. They're able to see what customers buy, but also what they don't buy. So they can see that if you click on an item and choose not to buy an item, but through later in your search end up buying another item, they're able to determine and figure out what your buying pattern. And it's actually very valuable to them as a company. As you can imagine, being able to determine which items sell, which items don't, and in their algorithms, being able to use this information to enhance their search and recommendations. They can also use this information for their own advertising business. Amazon in the cloud business had a first mover advantage, and allowed the company to run up the learning curve faster and develop a broad range of products and services to address customer needs and challenges. Amazon, through reinvesting in its business, has created significant economies of scale, driven by its vast marketplace, logistics, and distribution network. They've created a significant pool of sellers and benefits from a lower cost structure, which in turn allows the companies to pass on these cost savings to its customers in the form of lower prices. And this makes it very challenging for its competitors to compete against. When you compete against a company that continues to drive down its lower prices, you feel pinched and pressured to also do the same, which in turn drives down companies' margins and profitability, which makes it very difficult to compete. Within Amazon Web Services, Amazon has reduced its prices over 65 times since launching. And lastly, Amazon is a strategic allocator of capital with a focus on long-run growth. We really appreciate a management team that is forward-thinking and that prioritizes the reinvestment of capital for long-term growth rather than short-term gain. This allows Amazon to expand its business, grow its business, but also enter into new adjacent areas. For example, entering into the grocery market through its purchase of Whole Foods, producing its own private label products, investing in its own AI products such as Alexa, opening up Amazon Go cashierless stores, or launching its large Prime Day event, further advancing in its Amazon Web Services. And it continues to go on and on and on. And there's so much investments that it makes into its companies that makes it very difficult for other companies to catch up with them. And lastly, they have a low-cost structure and high operating cash flow that allows them to enter into new ventures. In 2019, they generated $38.5 billion operating cash flow. And as they invest in these new ventures, they're able to make mistakes and eventually hit a few home runs, which results in high return on investment. Lastly, I just want to pull out for everyone just a chart of a stock performance in comparison to one of its competitors, Walmart. Now, Walmart is another retailer that tries to differentiate itself as a retailer that focuses everyday low prices, very similar to Amazon. But as you can see in the chart there's quite a large divergence within the stock performance. Amazon generated 470%, while Walmart generated 67% when we look at from June 5th, 2016 to June 5th, 2020. Now, the difference markedly shows the superior power of Amazon's business model. Amazon, being a first mover in the e-commerce space, has amassed a significant amount of product offerings that you can't just find at Walmart. And Walmart has been relatively late to the game of e-commerce. Amazon has a forward-thinking mentality that grew its retail business, but also expanded into other businesses as well, creating multiple revenue streams and further building its virtuous cycle of growth. As you can see through this presentation, there's many reasons why we like Amazon. We believe that as it continues to reinvest into its business, that this virtuous cycle of growth will continue to expand and to grow, and which is why we believe Amazon is a very good long-term investment for our clients' portfolios. I'm now going to turn over our presentation to Jonathan for closing remarks.
Okay, thank you very much, Andrew. And hopefully get a better understanding of a couple of the companies that we own. And you think of Amazon, it's just a phenomenal franchise, to say the least. And when you compare it against Walmart, I mean, Walmart actually is a very, very successful retailer. It's been one of the most successful retailers. And boy, we could put up probably another 20 different retailers, and you'd see that they've just been eviscerated because their business models have really collapsed in the last little while. So putting it up against Walmart would probably be, especially in the last little while, one of the strongest comparables. But again, what we're trying to do is find companies with tremendous operating leverage and a model that's powerful, continues to grow. A lot of times people look at Amazon, they say, well, it doesn't make a lot of earnings. Well, it's plowing all its cash flow back into its business. And what you really have to do is look at Amazon as a multiple of revenue, with the idea that over time they can move the meter and create profits that are just huge over time. And so we're really driven more by the multiple of revenue. which is quite reasonable when you consider what the business is doing. And so Amazon's, again, a great example. It's one of these companies that actually has, unfortunately, I mean, it was fortunate for us, but unfortunate for other companies, it's profited significantly in this lockdown environment, as people know that their services did not stop at all. And you could, if you needed something, you could order everything online. And in terms of Algonquin, again, that's another great example of company that is dependable. It's essential. They didn't miss a beat in terms of these lockdowns. And when we looked at all of our infrastructure companies, whether it's TransAlta Renewables, whether it's Brookfield Infrastructure, Brookfield Renewable, Northland Power, Algonquin, these are substantial holdings across our clients. And again, even in a lockdown, whether you're at the office or at home, you're consuming energy and you need to use a lot of the infrastructure. And so in many cases, these companies all had record results in the first quarter. And in a number of cases, they actually increased dividends. And so again, just speaking to the power of those business models. So on the last slide, which I'm not going to pop up there, it just talks about our next webcast. And our next webcast, we're planning for September the 17th. And if there's more information in the market, or the market gets really crazy again, as we saw in March, end of February and March, then we'll probably do another webcast, update our clients. We'll see what happens depending on the market. But if everything's reasonably sane until September, if that's possible in this world that we live in, then we're going to schedule another webcast back in September the 17th. So we really appreciate your support. It's been a tumultuous year in one sense, but we've managed to stay ahead of things. We continue to be focused, very disciplined. We're not going to chase markets. We're going to look at great companies and value everything in a disciplined way. And we expect more volatility. Please expect volatility. There's going to be there's a lot of unknowns as we work through opening back up our economy again, and then trying to get people back to work and seeing what the damage has really been in terms of the decisions that have been made the last couple of months. So again, we thank you very much for your patronage. We appreciate all of our clients and look forward to speaking to each of you in due course. And if you have any questions at all, as you know, call us, email. You can stop by the office. We're open and we're raring to go. And we look forward to speaking to all of you. Thank you very much. And you have a good rest of the day. Bye now.